Imagine waking up one morning and finding out you've lost $5 billion. Not your company's money. Your money. Your net worth, just gone. Most people would panic. Sell everything. Retreat. Warren Buffett did something else entirely. Welcome back. Today we're talking about one of the least discussed chapters in Warren Buffett's career, the moments when he lost, not won. When billions evaporated from Berkshire Hathaway's portfolio. When Wall Street laughed at him. When headlines called him past his prime. And more importantly, we're talking about what he did next. Because those decisions? They reveal more about Buffett's genius than any of his wins ever could. Let's get into it. To understand the losses, we have to go back to 1999. The dot-com bubble was at full inflation. Companies with no revenue, no profits, sometimes no product, were being valued in the billions. The Nasdaq had climbed over 80% in a single year. Everyone was getting rich. Everyone except Warren Buffett. Berkshire Hathaway stock fell nearly 50% from mid-1998 to early 2000. 50%. On paper, Buffett had lost tens of billions of dollars in shareholder value. The cover of Barron's magazine, one of the most respected financial publications in the country, ran a headline that asked, bluntly, "What's wrong, Warren?" The article argued that Buffett had lost his touch. That he didn't understand technology. That the new economy had passed him by. And here's what makes this story extraordinary. Buffett's response wasn't to panic. It wasn't to chase the bubble. He went to the Berkshire annual meeting in 2000 and said, essentially, "I don't invest in things I don't understand. And I'm not going to start now." 12 months later, the Nasdaq had crashed 78%. Trillions of dollars in market value, gone. Warren Buffett? Still standing. But here's the thing. Buffett doesn't just lose money to market crashes. He's made some genuinely bad deals. And he'll be the first to admit it. The single most expensive mistake in Warren Buffett's career, by his own admission, wasn't a missed tech stock. It was a shoe company in Maine. In 1993, Buffett acquired Dexter Shoe Company for $433 million. But here's the critical detail. He didn't pay in cash. He paid in Berkshire Hathaway stock. At the time, Buffett believed Dexter had a durable competitive advantage, a moat, in his language. Quality American-made shoes at accessible prices. What he didn't fully account for was how quickly overseas manufacturing, particularly from China, would undercut American shoe producers on price. Within a decade, Dexter's competitive advantage had completely evaporated. The business was essentially worthless. But because he paid in Berkshire stock that kept compounding in value, the true cost of that mistake, accounting for what those shares would be worth today. Over $8 billion. Buffett has called Dexter Shoe the worst deal I ever made. He put that number in his own shareholder letter. No spin, no excuses. And that right there is the first lesson. One of the world's greatest investors doesn't hide his mistakes. He catalogs them, publicly, so he can learn from them, and so you can too. Then came 2008. The global financial crisis hit Berkshire Hathaway hard. Buffett was heavily invested in financial institutions, Wells Fargo, Goldman Sachs, U.S. Bancorp. As banks teetered and credit markets froze, Berkshire's portfolio dropped by roughly $25 billion in market value during the crisis year. Now, here's where most investors make a fatal mistake: they sell. They lock in losses. They let fear drive the portfolio. Buffett did the opposite. In October 2008, at the absolute depths of the panic, he published an op-ed in the New York Times titled, "Buy American. I Am." He wrote that he was personally moving his entire non-Berkshire net worth into U.S. equities. He argued that over the long run, betting against America had never paid off. That fear was the worst investment advisor you could have. And then he acted on it. During the crisis, Buffett deployed $15 billion in deals, including a legendary $5 billion investment in Goldman Sachs with highly favorable terms that only someone with his credibility and capital could have negotiated. 5 years later, those crisis-era investments had returned enormous gains. The lesson wasn't just buy the dip. It was build yourself so that when others are forced to sell, you have the strength to buy. Fast forward to 2020. COVID-19 hits. Global travel collapses overnight. Buffett had spent years building a combined position of nearly $10 billion in the 4 major U.S. airlines: Delta, American, Southwest, and United. He had believed the airline industry had finally consolidated enough to be investable. Fewer players, better pricing power, more predictable cash flows. Then the pandemic made every plane on Earth a liability. In May 2020, at Berkshire's virtual annual meeting, no crowd, just cameras, Buffett announced he had sold every single airline share at a significant loss. He estimated Berkshire had lost roughly $7 billion on the airline positions. And he said something remarkable. He said, "I made a mistake. Not the pandemic's fault. Not unforeseeable circumstances. Just, I was wrong about the business." He acknowledged that the airline industry's economics had fundamentally changed in ways he hadn't modeled correctly. Now, some critics jumped on this. They said Buffett sold the bottom. The airlines partially recovered later that year. And that's true. But here's the nuance. Buffett wasn't just managing money, he was managing Berkshire's reputation and capital structure. He decided that staying in businesses he no longer understood the future of was worse than taking the certain loss. That's a discipline most investors never develop, the ability to say, "I was wrong," and act on it, even publicly. So here's what's fascinating when you zoom out and look at all of these losses together: the dot-com mockery, Dexter Shoe, the financial crisis, the airlines. There is a pattern in how Buffett responds to every single one of them. 1. He takes full ownership. No external blame. No market conditions excuse. No. Everyone got that wrong. Buffett consistently says, "I made a mistake." This isn't humility theater, it's a learning mechanism. You can only fix what you own. 2. He does not abandon the framework. After the dot-com crash, he didn't suddenly pivot to tech. After Dexter Shoe, he didn't swear off consumer brands. After the airline losses, he didn't stop investing in cyclical businesses forever. He refined his criteria. He updated his thinking. But he kept the core system, buying wonderful businesses at fair prices, intact. This is the thing most people miss. It's not that Buffett never loses. It's that his losses don't destroy his system. Every investor, amateur or professional, will have losing positions. The question is whether those losses break your process. 3. He stays liquid for the next opportunity. After every major loss or market dislocation, Buffett makes sure Berkshire is holding significant cash reserves. He famously maintains a cash buffer, often $50 billion or more, precisely because he knows downturns are inevitable. When others are desperate, Berkshire is ready. There's something deeper here that I think most financial content misses. Warren Buffett's superpower is not that he picks more winners than losers. His superpower is his relationship with being wrong. Most investors, and honestly, most people, treat being wrong as an identity threat. If they admit a mistake, it feels like admitting they're bad at this. So they hold losing positions too long, hoping the market comes back to justify their original decision. Psychologists call this the sunk cost fallacy. Buffett has systematically removed ego from the equation. When Charlie Munger, his longtime partner, passed away in November 2023, one of the tributes that stuck most was about how Munger could say, "I was wrong," faster than almost anyone in business. That wasn't a personality quirk. It was a competitive advantage. Because the faster you accept you're wrong, the faster you can redeploy capital into something right. Warren Buffett has lost billions. Multiple times. Publicly. Painfully. And yet, starting from $10,000 in his early 20s, he built a net worth of well over $100 billion, mostly by compounding through every loss, every crash, every mistake. The takeaway isn't, losses don't matter. They do. It's that how you respond to losses is the actual determinant of long-term performance. Own the mistake. Keep the system. Stay ready. If this video helped you think differently about investing, or about failure, hit that like button, and subscribe if you haven't already. Every week we break down the lessons inside the world's greatest investors. And drop a comment. What's a financial mistake you learned the most from? I read every single one. See you next week.